Hi, Jim Gore from Thor Wealth Management. Today I want to talk about investor sentiment and where we are in the market. I've always heard that, hey, the market is different this time, and things are different in the market. But the one thing that is not different is the human emotions. And it follows this graph throughout my 35 years. We've seen people go from optimism to euphoria. Then all of a sudden the market starts going down. They fear, panic, despondency, and then back up to optimism. And we just saw this just happen in the last year and a half. If you look at back in end of 2019, people were very euphoric about the stock market and the economy overall. And then all of a sudden we had the COVID hit and we went all the way down to panic and despondency. There were some people that were selling out their positions at the worst time. And because of human emotions, this is why we've seen individual investors significantly underperform the market because they've made asset allocation decisions in their portfolio at the wrong time. When they're euphoric, they put more money to work. When they're despondent and panic stricken, they don't put money to work. We were telling clients back in April of last year, if you had any money, to invest it with us at that time because it was a great time to put money to work. So looking at investor sentiment, what are some things that you might want to look at? Well, one that is very popular is the University of Michigan Consumer Sentiment Index. But this is one that looks at the economy. So they're asking consumers how they feel about the economy. This is not the stock market, but it does have some impact on the stock market. If you notice from 1965 all the way down to 1980, you saw the Consumer Sentiment Index go from over 100 down to where it was below 50 back in 1980. If you put money invested in 1965 through 1980, you didn't make much money in the stock market. But if you put money in 1980, it was a very good time to invest. And you can also see the sentiment index peaked out in 2000 and dropped all the way to 2008. And if you invested in the stock market from 2000, put all your money in there in the S&P 500 to the end of 2008, you actually lost money in your portfolio. So the bottom part, when the consumer sentiment index is on the low side, is a very good indicator to buy into the market. Now, at a high, is it a good time to sell? No, because as you can see, consumer sentiment index can actually go higher for a little bit longer time period. And you can see back in 2018, we've got that little red dot up there. It was over 100, and consumer sentiment, that was showing us that people were, in 2018, 2019, people were euphoric about the stock market, but also the economy. You've seen the dip here recently with COVID, and we've come back. I don't think that we're seeing euphoria in the consumer sentiment index because it is the economy. As I said, it's not the stock market. And you have to look at other indicators for the stock market, and I'll show you one in a minute. So it's gone up here, but I think it's being held back because people are fearful of inflation. In every survey now, you're seeing inflation as a bigger and bigger concern, and that is impacting people's thought on the economy. Back in 2018, 2019, you weren't concerned about inflation, but now that is out there, and that's what I think is holding back consumer sentiment. So this is not telling you anything on the stock market. It's just telling you the overall economy. But what indicator could you use to show euphoria? And this is one indicator that you should be looking at. It's margin interest. And this is something that is different than is what has happened in the past. Now, margin interest, or margin debt, if you will, is where people borrow money to buy stocks. And you can see that it peaked if you're going back in March of 2000, when the market peaked. It also peaked in 2007 before the market collapsed in 2008 and 2009. And we had recessions in that time period. Notice margin debt fell in those time periods. People were not borrowing money to buy stocks in the stock market. This time it is different. We had the prior peak before we are right now was back in 2018. Margin interest started coming down, and along with the stock market, they're selling off securities that they were borrowing to get. But this is the first time we've seen a recession where margin debt has actually gone up, and you can see it's gone up very significantly over the last year. And what this is telling me is that investors are euphoric. They are putting money to work in the market that is not theirs. They're borrowing money to do that. And that kind of goes back to our Thordex, which we talked about before. I'm not going to go too much into this. It is at over 83 right now. Anything over 80 in the S&P 500, the next 10 years averages 1.8% rate of return. What this is saying is that the risk is high in the stock market. There is euphoria with the amount of debt that people are taking on and margin debt. And this is one that is saying to us that human emotions, people are more towards the thrill and euphoria side at this juncture. And it's been one of the shortest time periods. We've gone from despondency to thrill and euphoria. But it's something that if you have money right now, putting it to work in the market, you have to be very careful, especially in U.S. stocks and U.S. large company stocks. Hope everyone has a great couple of weeks here. And if you have any questions at all, feel free to give us a call or email us at any time.